Hello, everyone. Good morning or good afternoon, depending on where you're connecting in from. My name is Ian Cochran, and I am a senior advisor at the Institute for Climate Economics. And I am also the head of the Secretariat of the Climate Action in Financial Institutions Initiative. And today I have the pleasure of welcoming all of you to our event, which we are doing jointly with the United Nations Environment Programme Finance Initiative, UNEP-FI, and with the support of the Finance in Common Summit. And this event is part of the London Climate Action Week, and our London Climate Action Week partner for the event is CDC Group. And of course, we want to thank all of them for this help and assistance in getting the event organized today. So today, we are starting a set of discussions that we are looking to hold between now and COP26 on the broader topic of aligning financial change with the Paris Agreement. And today, we're going to be focusing specifically on the issue of why, and in some instances when, are financial institutions focusing on the alignment of counterparties. Before we dive into today's content, I just wanted to do a quick note to participants. So this webinar is being recorded and will be made available via a number of different platforms, including the Climate Action in Financial Institutions website. Also, we do have a question and answer period scheduled for later in the session today. So please do share any questions, reactions, or your own experience within the chat, and we hopefully will be able to get to as many of those questions and reactions as possible a little bit later in the webinar. So just as a quick overview of today's agenda, we're going to be hearing briefly from myself as an introduction to perhaps say a couple more words about what we actually are talking about when we use the term alignment of financial chains. We'll then hear from Amelie Amin, who's Senior Advisor on Public Finance and Strategy to the UK COP26 presidency. And she'll be saying a few words about how the broader subject alignment, and of course what we're looking at today, fits within the agenda and the run-up to the events in Glasgow later this year. We'll then have a panel discussion where I'm very happy to welcome 5 representatives from different financial institutions who will address a set of questions around what their institutions are doing on alignment, and more broadly, how, when, and in some, of course, instances, why they are looking at the issue of the alignment of counterparties. And I'll be introducing each one of our panelists a little bit later on when we get to the panel. We then hope, as I said, to have a little bit of time for questions and answers and discussion with the panel, where we'll look to take the different questions in the chat, or even see if any of the panelists have questions for each other, and then we'll hear a few concluding remarks and the road forward in terms of what we look to do in the coming months from Eric Usher, who is the head of UNEP-FI. So before we got to today's panel, I did want to perhaps clarify a little bit this term that is something maybe new for many of you when we're talking about the broader process of alignment of the goals of the Paris Agreement. And as hopefully everyone on the call knows, out of Paris in 2015, we saw Article 2.1c and that core goal of the agreement of making financial flows consistent with a pathway towards low greenhouse gas emissions and climate resilient development. And since the COP, we've seen a number of financial actors, and happily a growing number, begin to think about alignment and what it means in practice. But often, given their different points of departure, either because of their business models, what part of the financial sector they're working in, and the different forms of the financial transactions and relations they have with their clients, we saw a number of different entry points on this bigger question of alignment, where quite a few institutions, and here particularly those dealing with project finance and perhaps different products with known use of proceeds, we saw the question often being framed around the alignment of what is financed. So how are those individual projects or business activities aligned with the Paris goals? But on the other hand, for those financial actors who perhaps are focused a bit more on the actual clients themselves or those actors involved in corporate and retail lending, different forms of equity investment, particularly those around non-pure players. We saw an entry point more around that question of who is financed. And here this question of the consistency of the strategies and the whole set of activities of a client or counterparty. And today, over 5 years in from the Paris Agreement and over 3 to 4 years following a lot of the commitments that have come out around alignment, I think what we are seeing and what we hope to touch on today is the fact that moving forward, financial institutions most likely will need to be looking at both the what and the who of what they're financed and how that is aligned with the Paris Agreement, and really understanding again this idea of the alignment of the entire financial chain. And to just a little diagram that might help a little bit for us to really think about this. So, most financial institutions start with that idea of, is my portfolio aligned? And then to think about that, some of them, of course, are asking that question of, how are the recipients of the financing I provide or the investment I provide, are they aligned or not? Whereas, as I said, others might be looking more at, are the actual end projects and activities aligned, without perhaps looking initially at the alignment of the counterparty itself, as again, their focus is more on that end investment. And for other actors, particularly a lot of the development finance institutions who are working through intermediaries or funds, there's this bigger question of, are my partners aligned? Are those that I'm working with also seeking to ensure that their strategies and again, transactions are consistent with the Paris goals? And perhaps a newer set of questions that are starting to arise are for those those actors who are selling bonds to finance their activities. They're asking whether or not the buyers of their bond, so the upstream counterparties and those investors, are aligned, and whether that bond purchase, where their bond is ending up in terms of portfolio, is part of a broader and consistent strategy. So what this probably shows is that there's a lot of questions and quite a few lines of connections between them. But what we've noticed and what we're hoping to do today is to start a conversation across 3 areas. As we know, most financial institutions are asking themselves, why and when should we focus on the alignment of different parts of the financial chain? So when is it best to focus on who, or when is it best to focus on what, and when do we actually need to be looking at both? We're also looking at questions around, how can FIs assess that alignment? And here, we do see quite a bit of quick movement in practice over the last few years, but today quite a bit of overlap as well between approaches that might be focused at the counterparty level or those that are focused on the project level, and again, a lot of similar questions. And then finally, there's that kind of overarching large question of, what should a financial institution actually do with the results of these alignment assessments? And how should they be integrating this into their management and broader strategic decision-making, their individual transaction or client-related decisions and transactions, and of course, these big ideas, bigger questions around avoidance, engagement, building awareness at both strategic and operational levels, etc. And I've thrown it up here. I'm not going to go through each one of these in turn, but I think what we do see is from these 3 questions, there's a lot of offshoots. So there's definitely quite a bit of very fertile ground for conversation around this alignment of financial chains question, around use of proceeds, the technical challenges. Do we need to go beyond a binary yes/no assessment of alignment to something a bit more nuanced? And then finally, again, what do we do with this information? How do we use it to support both risk management and positive climate impact internally, but also within our clients and within our counterparties, et cetera? And then, of course, finally, this big question of, what do we expect from regulators? As again, we do see different groups of regulators or individual regulators moving forward and also seeking to integrate this into their oversight activities. And I'll end this, my perhaps not so quick introduction, just on saying what we hope again to do in this conversation. So we see the need today potentially, and what we're hoping again to launch today, for a forum among financial institutions on this alignment of financial chains, and bringing together an informal group of FIs to exchange on this point, to facilitate cross-capitalization and knowledge sharing, to foster collective emulation and convergence of approaches, and also help send signals to the broader financial community about how this question of, again, the alignment of financial chains being a key part of every FI's alignment journey. So I'll end my introduction now, and I'd like to pass things over to Amélie, who, again, in her capacity as Senior Advisor on Public Finance and Strategy, will say a few words about how this broader alignment question is being addressed by the UK COP26 presidency. So Amélie, over to you.
Thank you very much, Ian, and for the opportunity for us as CDC to actually partner with this initiative in the context of London Climate Action Week and looking ahead to Glasgow. So, I think, as everyone is probably aware, climate finance, both the role of public finance and also increasingly the role of the private sector, is a key priority for the COP26 presidency and the agenda building up to Glasgow. And that, of course, is a focus within what's happening more formally within the UN process, in particular the delivery of the 100 billion to ensure that is being met, as well as looking ahead to future collective climate finance goal. But also the recognizing the links to the real economy and how, in particular, that $100 billion commitment has led to and incentivized climate actions, climate finance from a whole range of actors, particularly the public sector financial institutions, so the multilateral development banks, the IDFC members, and also I think what we're seeing sort of increasingly, those private sector DFIs such as ourselves, CDC, that are increasingly working to deliver on that 100 billion commitment. And that, of course, is a big part of the agenda in terms of not just thinking about a delivery of the 100 billion, which of course is essential and critical, but also importantly the quality and the accessibility of those resources to ensure that all countries are accessing, but also all communities can better access. As well as the quality in terms of mobilization and in terms of looking at adaptation finance, which we know in many cases won't be large volumes of finance, given the nature of how adaptation resilience investments are made, and also that many of the new emerging business opportunities are quite small scale. So recognizing that, the need to focus, in addition to the 100 billion, in addition to quantity, to have a focus on quality and accessibility of climate finance is a big priority. And the role of the public financial institutions represented here, as well as increasingly the private sector, in enabling that. And a big part of that is looking at how all financial flows can be aligned with the goals of the Paris Agreement. So the need to stay within to 1.5 degrees, which is now being interpreted as the need to finance or ensure that financial individual transactions, but also the portfolio of financial institutions are net zero before or at or by 2050. And so this is a key aspect of Paris alignment that I think we'll be discussing obviously later in through the panel, where different financial institutions can and must actually start to engage with and ensure that the resources that they are bringing, which largely in many cases will contribute towards this 100 billion figure, are having a very, very catalytic effect. So really then leading to those more systemic changes across the financial sector to deliver then the trillions that we know are going to be needed for the transition to net zero. But similarly, recognizing the importance of increasing importance, particularly in the developing world and emerging markets, to ensure the resiliency of the financial sector, both resiliency of specific investments and as well as how increasingly the financial sector can help ensure that they are financing and contributing in that way towards countries' adaptation needs. So these are two very critical elements of the Paris alignment agenda that I think, thinking through how we move beyond thinking about Paris alignment as okay, yes, we're looking at our portfolio and we know we're going to be aligned to very much, as you said, Ian, that this is about driving those changes, driving all financial flows ultimately towards the goals and objectives of the Paris Agreement. So this event is an initiative is extremely timely and very, very welcome. And thank you very much as well for the invitation to participate and contribute at CDC, as well as to say a few words in my role as advisor to the COP26 presidency team. Thank you.
Great. Thank you so much, Emily. I think that really does help frame this broader conversation within the impact and the outcomes that we are seeking to have globally around the agreement. And of course, moving forward from Glasgow, where I just happen to be physically located as well, this coming November. And apologies for this slide, as again, Emily was able to confirm last minute, and so we hadn't updated that slide. So more than TBC and very much confirmed. So thanks so much for being able to say a few words. Now, moving on, I'd like to invite our panelists to turn on their cameras, perhaps not turn on their mics yet, as I do just want to introduce the great panel that we have lined up for everyone today. Firstly, we'll be hearing from Camille Laurent Villain, who's the climate finance lead in the strategy department at the French Development Agency. We also have Simon Connell, who's the global head sustainability strategy, at Standard Chartered Bank. And then also, of course, from Amélie Amin in her role, of course, as climate change director of CDC Group. We're also really happy to welcome Anthony or Tony Bayabriga, global head of responsible business from BBVA. And then we will be joined a little bit later by Wouter Mindersma, who's a climate change specialist at the European Investment Bank. However, unfortunately, in the end, the EIB will be a little bit late given overlap with a competing consultation on their climate strategy that they also had scheduled for today. So he'll be joining us closer to 2 o'clock CEST. So we'll do a first round of hearing from each of our panelists. And again, as I said, a lot of institutions are approaching this question from a different point of departure, given their business models, the sectors, and the parts of the financial chain that they're involved in. But it'd be really interesting to hear from each of you about why is assessing alignment at both the transaction and the counterparty level important, and perhaps a few words about when does this make the most sense for your institution, and then also a few words on perhaps how and where you are, as well as your broader group, in terms of beginning to look at this question and the different challenges that it might pose. So here, I think, Camille, if we could start with you, that would be great to hear a little bit about how the AFD is approaching the subject and where you are today.
Okay, thank you, Jan. Thanks a lot for having me in this session. I'm very honored to share the floor with this distinguished panel this afternoon. Looking forward to sharing our experience and moving forward with this group on the current challenges we have identified. So at IFD back in 2017, we became the first development bank with the explicit mandate to align 100% of our activities with the Paris Agreement. We understand the concept of alignment as a way to increase climate ambition and to generate action within the financial community through 3 channels. First, by increasing climate finance for mitigation and adaptation. Second, by supporting actors in their low carbon and resilient transition. And third, by avoiding investment that lock in countries in very emissive pathways or lead to maladaptation. So in terms of financial and technical supports provided at IFD, we work with different tools. We have earmark loans with eligibility criteria for the use of proceeds. So for these credits, we focus our assessment on the project level because we know exactly what is being financed. And of course, in the analysis, we also put the project in perspective with the issues faced by the borrower on climate to understand how IFD support can contribute to tackle key issues. We also work with non-earmarked credit lines with specific triggers related to climate or not, climate objective or other objectives. For example, just to illustrate, IFD is providing the African Export-Import Bank with credit facility associated to the achievement of a number of milestones related to the implementation of the bank's new climate strategy. So those financing aim at supporting partners' overall activities and strategy. So we need to understand where the borrower stands in terms of alignment with the Paris Agreement if we want to be able to answer the question, is this operation aligned or not? So in both cases, earmarked credit lines or non-earmarked credit lines, the question of whether the actor we finance is aligned or not is really relevant for us and is a part of our commitment to align our operation with the Paris Agreement. And we know that it's very important to keep financing green projects, but we also need to question ourselves on the relevance of financing clients largely relying on brown assets that have no strategy to reduce their exposure to these assets in the short or medium terms. And we see this analysis at the borrower level, at the counterparty level, as an opportunity to better understand how our clients are exposed to climate risks and to help those who are the most vulnerable to work with them on their strategy to mitigate those risks. Because as a development bank, we really think that our mandate is to support our partners' transition and not to exclude them. So for all this reason, we consider at IFD that the client or counterparty level is important. Now, let me say a few words about how we are approaching alignment in both areas. At the transaction level, we put in place a specific methodology. So we check the compliance of the financing with the country NDC and with public policies, taking into account, of course, the country's major climate challenges. So the project that might have structural lock-in effects or project that have a risk of maladaptation are excluded early in the appraisal process. And this methodology is also an opportunity to determine whether the transaction could have a significant leverage on climate issues and at what conditions with the clients. And at the counterparty level, we decided at IFD to try answering the question, will the operation we finance contribute to the alignment of the actor we work with, rather than addressing the question of, is the actor aligned or not? Because we believe that alignment with the Paris Agreement is a process. It depends on the national context. And really, we see our mandate as a development bank to help our clients in this process, rather than deciding to exclude those who are not aligned yet. So we have started to work with two different types of clients, energy actors like utilities and financial institutions. And we think that a better understanding of who we finance means striving to make more in-depth quantitative and qualitative analysis of counterparts' assets and exposure to fossil fuels, to look at the trends, to see if the exposure is decreasing or increasing, and to put that in perspective with the context of their activities, the regulatory framework, and of course, their willingness and commitment to align. So we really started recently this approach. We have been launching a test phase that will help us assessing its relevance and its feasibility. And of course, we anticipate some difficulties for example, collecting information, because we know that the accounts or the balance sheets of the institution we work with do not systematically disclose the breakdown of the portfolio, for example, or the assets by sector. And we also anticipate difficulties in the case of our client does not want to raise its ambition in terms of alignment. So what should we do in that specific case? We believe at IFD that we should provide incentives by adapting our tools, depending, of course, on the initial diagnostic, and to encourage our counterparts to raise their ambition and to align with the Paris Agreement. Thank you, Jan.
Great. Thanks, Kemi. I think that definitely gives a great overview of how both that project and the counterparty level is being approached, definitely from obviously an actor who's seeking impact and of course seeking to accompany their clients in terms of alignment and help bring the resources needed whenever possible to support that. But I think there are also, of course, a lot of questions about how do you go about doing that assessment, evaluating that risk of lock-in, and really in some sense, perhaps what others have also called that transition potential of the actual counterparty in front of you. So thanks, Kemi. I think now I'd like to turn, and of course, shifting gears a little bit to have Simon from Standard Chartered Bank. Perhaps, Simon, if you want to come in here and say a few words, of course, around the similar topics of, when is Standard Chartered looking at this issue of more use of proceeds versus aggregate counterparty alignment, and perhaps the how that you're starting to do it in some of those challenges.
Great, thank you, Ian. And I really enjoyed Camilla's inputs. I worry this is one of those panels where we all agree violently with each other, but as you say, hopefully coming at this from a slightly different institutional perspective. So I think if I think about the most inward-facing approach here, it's the climate risk approach. And of course, it was where Governor of the Bank of England, Mark Carney, started us with his Tragedy of the Horizon speech. But really, you're thinking about how do I minimize my exposure to climate risk, physical risk, transition risk, but that's effectively passing it somewhere else. It's not assuming you're part of a system, or at least it's not assuming that those issues impact you if you push them outside of your sphere. I think moving one step into a more altruistic model, we've got the asset-based alignment. Okay, how am I helping the transition through assets? But then I think if we move furthest into that dimension of thinking, we get to counterparty alignment, which is then through the counterparties to whom I have exposure to the economy, how is my support of them helping them transition, and therefore helping economies as a whole transition? And so I want to acknowledge that in that, you move towards the most laudable goals, but it is also the most challenging path to take, because you're starting to look at things that are certainly well outside of the control of a private financial sector organization. You're trying to say, how do I best use my leverage here? And we've been working on those three challenges, I think, since 2018. Well, since before then, from a climate risk perspective, but particularly alignment at an asset or a counterparty level. And I think supported, as many have been in the past year or so, by a net zero commitment to align our financed emissions to net zero by 2050. And again, if we come back to this concept of, well, what are we trying to do? I think the framing I tend to have in my mind is companies have a stock of productive assets. Okay, often capital equipment, whether we're talking things as bulky as power plants or as small as a fleet of vehicles, and replenishment of those assets is supported by finance flows. And if we think about the new assets coming into a company to replace some of their existing stock of assets, those assets are more likely to be transition positive. But at the same time, we have the challenge that different financial sector actors get different levels of exposure to those specific assets that are coming in as the replenishment. So if I'm an equity holder in a company and I just own broad-based equity, I have to take a slice of everything because there's no direct attribution of my financing. I think if you're a bank, you can have direct attribution of your financing where it is asset-backed financing, whether that's on capital equipment financing for those vehicles or whether that's on project financing. But we also have the challenge that is only a portion of our activities and our balance sheet. So we're lucky to be able to do that, but it's not everything we do. And I would suspect here, again, maybe for discussion around the panel, that private sector banks probably do less asset-directed financing than multilaterals. So there's a business model challenge we have to work around there. But I think as was said by Camille, the challenge here is, when you're thinking about counterparty alignment, how do you avoid maltransition? How are you trying to make sure that you're playing enough of a role on asset-backed financing that you're helping to support your client's transition, but that you're aware of their overall transition, and you're also balancing that with where you have general purpose lending. Again, you're thinking about mechanisms for that. And so for us, one of the ways that we've been working, as others have, we have a coal policy, and we've expressed that in revenue terms. So we want to see our clients reducing their revenue from thermal coal to below 5% by 2030. And we've got a series of interim thresholds, and we're trying to engage with clients to keep them on the right side of that. Some might be unwilling, some might be unable, based on their business model, to transition. And we ceased providing financial services to 4 clients in 2020 who were unwilling or unable to transition in alignment with that. So again, trying to think of that mix of, for example, deploying, I think, $18.4 billion towards clean technology last year. How are we helping with the replenishment of stock of assets for energy companies to try and support their transition? But how are you having a whole of entity measure where you can to try and make sure who's not on that transition journey at the right pace? But this is very much work in progress, and therefore I think, to my mind, there's, and I'd like to call out sort of 2 areas in which I think there's progress being made, one on the asset-based and one on the portfolio alignment. On asset-based, I feel there's a lot of good work coming out of taxonomy, clearly taxonomy in the context of the EU Sustainable Finance Taxonomy, but of course we're seeing this concept of taxonomy internationalized, including through the International Platform on Sustainable Finance, and we're participating there. I think we're now into our 2nd phase in a project with the UNEP FI and the European Banking Federation to try and get banks working practically on taxonomy. And of course, using that to unpack some of these challenges of what is a green asset, but also what might a transition aligned asset look like, and therefore even at that asset flow level, trying to avoid the maltransition. But then the portfolio alignment challenges really trying to work for us through a variety of platforms, but I think one of the most important and most recent here is the Net Zero Banking Alliance, and that rolling up to the GFANZ, the Glasgow Financial Alliance for Net Zero. GFANZ is important because, of course, it brings together the different parts of the financial sector. Back to my earlier point, if you're looking at this purely selfishly from trying to push climate risk out of your organization, you're quite happy to give it to someone else. But we can't get the system itself aligned to net zero unless everyone's trying to work on that problem together. And then NZBA being a place where, because so much of this is at an early stage, that the banking sector itself can come together. It can develop both consistent approaches, because as we've seen with TCFD for the best part of 5 years now, we can all be trying to do the same thing, but doing it slightly differently. And that inconsistency can actually hold back progress. So I think standardization from the earliest possible point in time is a laudable effort. But the other is also trying to work together to solve some of the challenges. And again, I'm not going to cover those too much detail because Camille touched on them. I'm sure others will. But really some of these, the IEA NZE 2050 scenario being an incredibly helpful thing. But how do you get that to the level of granularity? How do you understand all the assumptions in there? How do you use that and supplement it where you need to help understand where you need to be on your journey? How do you create the data that allows you to assess at both asset and counterparty level your progress toward there? How do you make sure that everybody else is understanding what you're using and preferably using some of the same metrics? And one of the things that we've been working on, again, in that space is warming potential metrics. So our 2020 TCFD report contained warming potential metrics for around 100 corporate counterparties. No surprise, coming at around 3.14 degrees. I think at the moment, of course, everybody's a representative actor in the economy, but we've scaled that up. We've now internally got portfolio warming, or sorry, a mix these implied temperature rise, warming potential, or portfolio data for about 1,000 corporate clients, and we're continuing that program. So again, this helping us understand at an asset level, how are you getting exposure to things, how are you helping the transition, but then how far is that then, often in a situation where you're one of a number of banks providing financial services to a client, how are you helping bend the curve more generally? So hopefully that helps a little, doesn't cover too much that others might cover. So passing back to you, Ian.
Great, thank you, Simon. And I think that's a great way to see it, of how do you move from that kind of inward-looking own exposure to, again, this broader exposure of the entire economy and society in some respects to these risks of lock-in, whether it's around the mitigation or the adaptation resiliency side as well. We could probably take that next step. And I think that's a very interesting point you raise at the end, and we might come back to during the next round on how do you really, as a single actor, can you really do as much as, if you're able to work with the entire financial sector to bend the curve, and when do different approaches make sense, as a block rather than as an individual financial institution. But I think now I'll hand things back to Amelie, particularly as, you raised that point, Simon, around some of those challenges and the differences between when you're looking at equity versus debt. And I know, particularly given the way that CDC Group intervenes and works with its clients, that's definitely a challenge on your plate, Amelie. So I'll hand things over to you if you want to come in now again.
Thank you. And I think, Simon made exactly the right point. I think we probably all going to vehemently agree with each other, because definitely a lot, in fact, all of what both Camille and Simon said resonates very much with what we're trying to do. And, I think also, as said, this is, it's relatively early days, and it's great that, we're all sort of getting started on this, and obviously can learn a lot from each other as we go. I think for us, and CDC's new climate strategy, the key question for us as a DFI is less whether we are about delivering climate finance. It's important, but less about that, and more around how we as a development finance investor can help build a carbon-free world and resilient world that also delivers, strong economic growth and improved living standards. And so that's very much the sort of overarching approach that we take. And as we've developed our approach towards Paris alignment, that is very much reflected, where when we look at, so we look at Paris alignment in three main dimensions, actually, all of which are relevant here. The first being net zero, which we take a portfolio level assessment as well as at the transactional level. The second is how we can increasingly, through our finance and engagement and market shaping activities, in partnership with others, how we can contribute towards a just transition for workers and communities. And thirdly, how we can ensure that we are, through our investments, both financing, but also support through engagement, technical assistance, contributing towards adaptation and resiliency needs of countries and sectors, and of course businesses. And so all three of these objectives that we have set out, we see as increasingly important, not just for assessing at the transactional level or asset level, but critically how we can have that more systemic positive impact throughout the financial chain. And I think, as Simon made some very good points, that in some cases, where we, CDC, we've done a lot of general purpose investments and lending, both in funds and in FIs, and there you do end up with some, it's challenging to then, what is the approach then towards promoting and encouraging Paris alignment? I would say to a large extent, we have coal exclusion, so we have a requirement that the FI or fund would not make any more coal investments. So okay, if they've got some within the portfolio, at this stage, but no future coal investments. But of course, that's really just the starting point. And, how do we really go beyond that? We've also, from a lending perspective, we are now very much focused on looking at more directed lending. So moving from those general to directed lending and green directed lending or lines of credit. And in that context, so we're in the, this is sort of, again, relatively new for CDC, and we are through that process. Then we have an expectation. It's not really a formal requirement at this point, but an expectation that the financial institution will have an intention to apply best practice in relation to both TCFD, the Task Force on Climate-Related Financial Disclosure, as well as Paris alignment. So we see the TCFD pillars actually as a useful framing. So, i.e., how we would engage or understand how the financial institution, how it's looking at climate risk and opportunity within those 4 pillars of governance, strategy, risk management, and metrics. And and that we see as a useful starting point for that assessment. So as I said, it's still fairly early days. We have we've also with some of our companies already, or some of our financial institutions in our portfolio, we've also started to engage on these issues, on helping them understand the issues around TCFD, and then moving on to Paris alignment. So and that's very much not recognizing it's not just about new investments, but also how you can bring those investments within your portfolio along on this journey as well. And so as I think, I'm sure we'll come on to this part of the discussion. I mean, Simon set out many of the challenges, which I think we're all facing. But it is clear, or it's becoming clearer, that it does require us applying both expertise that we have in-house, as well as technical assistance to support our investees and our clients, because and our counterparties, because it's really about bringing everyone on this journey towards net zero, and then critically adaptation and resilience, which is, I think maybe the even more challenging part of the climate risk agenda. When we think about, we talk about transferring climate risk. I think often there's a perception that's mainly about transition risk. But I think the geographies and markets that we invest in, which is Africa and South Asia, we know are particularly vulnerable to physical impacts of climate change. And as a development finance institution, we're not going to say, okay, we're just not going to invest in those sectors that we see as particularly risky. So how do we ensure that we really drive that sort of systemic approach, so that financial institutions that we are investing either through lending or equity investments, how they are able to address those issues, better assess where those risks are coming, and then very, very importantly, deliver on those resiliency elements that are going to be needed to keep their different clients across a whole range of sectors, that they're able to ensure that there is the climate adaptation resilience is being fully integrated into their business models, business strategies, and the right tool, and have a clear and strong use of understanding of how best to apply data. And I think given the complexities of the data, I mean, it is becoming more, obviously with technology, and we're seeing more and more use of artificial intelligence, which is able to apply climate science data into financial decision making. It's becoming more common, but it's still a very complex agenda. So all of these activities have to be part of what we do now as a DFI, if we're really to ensure that we're contributing towards the the economic and social just transition to net zero and resilient economies.
Great, thank you, Emily. And I think there I'd really draw out that point you make of that support to your clients and your counterparties to be able to help them, particularly around the resiliency topic, have in some sense those governance changes, strategy changes, do things differently to build that resilience. And I'm sure that's also probably very resource intensive on your end. So there is always that question of where are different parts of the financial system both best suited in terms of the role CDC can play compared to perhaps a commercial institution that might have less margin. Although I know there are always questions about availability of funds for TC, even within public institutions these days, to help support that. And I think, again, a point I'd like to draw out as well, if I may, is that point on the data and the complexity of data. And I think here it's something that we've seen in our work at I4C and within the conversations around this in the climate action, that at times, we can look quite a bit at quantitative data, but there's still quite a bit of qualitative insights that are needed as well. And at times it's a bit more of an art than a science in doing some of these assessments. So perhaps in the next round, it'd be interesting to hear everybody's thoughts on that. But I now would like to turn to Tony from BBVA to again now kind of shift gears and hear, again, more from a commercial institution's perspective on where you see the transaction level versus counterparty level alignment focus, being most appropriate, and of course how BBVA is moving forward in trying to identify who are those aligned counterparties and how do you begin to work with them or help those who potentially aren't aligned yet or aren't quite, that's not quite on the radar. I'll leave it there. Thanks, Tony.
Okay, thank you very much, Jan, and well, thank you for the invitation. Great to be here. Well, a lot has been said already. I mean, we said that we all agree here, but well, I would say, but maybe here, but not everyone in the market and even not regulators agree in this more holistic approach to alignment, no? Well, especially when defining taxonomies. And I think that we still have relevant differences how to do it, no? The challenges how to do it, no? So our approach is that, well, very simple, as has been said, we need a transition of the whole economy, and not only to mobilize funds to poor sustainability activities. No, banks finance 70% of the economy. I don't know how much, but use of proceeds is relevant. But there are a huge amount of financing through lending at client level. So we need to assess transition at the client level, open it up. So assessment at the activity level is very helpful. It's necessary. We celebrate the approach. For instance, in this case, we are from Spain, and we celebrate the approach from the Euro taxonomy with the European Commission, and we celebrate also the evolution they are having, trying to incorporate or to integrate transition in financing, a complementary approach, including what they call activities in transition. But we think that is not enough, and I used to say that there is a green life beyond taxonomy at activity level. No, first because the goal is, as the Paris agreements states, is to make financial flows consistent. So is all financial flows consistent, no? Not only those to sustainability activities. Our approach also, as Standard Chartered and other commercial banks and other multilateral banks, is to help our clients in the transition. So I would say that alignment is not a status, is a journey, is a how we can help our clients to follow the pathway, the transformation they have to have, and it's a moving target. So that's very important. No? And there are also financial products and instruments that are more suited to an entity level approach than to use of proceeds, like for instance the KPI linked loans, which are very popular, no, in banking. No, and finally, why? Because we cannot reduce to measure alignment using only activity level ratios, and we need other type of metrics. For instance, the green activity ratio in Europe can be very helpful, but you will have only a small part of the movie with this ratio. No, we could imagine even a bank with a portfolio with all their clients with science-based target initiative and KPI linked loans with those targets, which should be, in our opinion, an aligned credit portfolio, but at the same time, only maybe 30% green asset ratio, because the exposure aligned with the taxonomy at the activity level is reduced. No, so to capture the full assessment, we need to make the assessment at activity level, where the taxonomy is, at least in Europe, is very helpful. But also we have to capture the force that doing a company, a client as a whole, no? And so that's the and our proposal would be in line with the latest report from the Global Financial Market Association, where we should define products and instruments that are more suited to an entity level approach than use of proceeds model. No, define a framework for standards and methodologies for use by external providers and rating agencies to support entity level assessments. Define metrics and thresholds at the activity level, at the client level, and enhance the standardized disclosure. No? How we are approaching at BBVA? Well, our approach to alignment start in Katowice. In fact, it was together with our colleague Simon and with Standard Chartered, also with ING, BNP Paribas, and Société Générale, signing the Katowice Commitment in December 2018 to define methodologies, to open methodologies to help banks to align our lending portfolios with the Paris Agreement. A statement that was reinforced and extended to more wider community with the collective commitment to climate action promoted by UNEP-FI in 2019. And now, as Simon says, no, with the Net Zero Banking Alliance, where we have 43 banks committed with our net zero by 2050. No? So, but we are working in two areas. Obviously, one in terms of sustainable finance mobilization. So we have a pledge 2025 to commit 100 billion euros between 2018 and 2025. We consider with this pledge not only an approach linked to activity, but also at the company level. So we go beyond at the beyond activity level. So we include obviously KPI linked loans, KPI linked bonds, and all the finance mobilization we do, always following the best standard market standards like the IGMA or the LMA principles. No, so this is our roadmap, no? Aligning with the taxonomy at activity level, but at a client level using the best standards that we have in the market. And then in the second part, in terms of alignment, is regarding risk management and impact, as also was mentioned before. No, we have some specific commitments in thresholds and sector norms. We have a phase out also on coal, and we are working together with other banks like Standard Chartered, implementing methodologies inspired in Impacta, and also using intensity metrics and PCAF in our case also for some sectors, following the guidance on target setting developed by UNEP-FI recently, and announced in April, and to define specific metrics per sector, and making an assessment at the client level, and trying to qualify the clients in those that are already aligned today, but maybe not aligned in 2 years' time if they don't do nothing. So they are aligned today. Clients in a second bucket, we have clients that are not aligned but are on track. It means that maybe the starting point is not so good, but they are having plans, let's say, moving forward on the pathway we need. No, and then we have a third bucket of clients that are not aligned and off track, where they don't have plans to do that. And that's the percentage of the clients that are not aligned and off track is those percentages that we want to reduce, no, and to want to help our clients not only through financial services but also through advisory services, no, to help them in the transition. No? And to conclude, around challenges, we have a lot, as was mentioned, especially on data that we have from clients. We will do a request to regulators, obviously, to enhance and standardize disclosure, to facilitate mapping revenue and assets to different industries, subsectors, and activities. We hope, we expect in Europe, where we are having very strong support from the European Commission on that, and we are totally convinced that will happen. But we need a global approach on that, and we hope that the work that will be developed by the IFRS Foundation with the new sustainability board will help a lot in order to standardize those metrics that we need at client level to make this assessment. And also, I would say that to the banking community, we need to keep moving, keep sharing, to work collectively to promote this sense of momentum and alliance to help the whole economy to transition. Because, as was mentioned also, we cannot do a lot alone. We need to engage with all the stakeholders, and especially with other banks, commercial banks. And now today, I'm very happy to be here with multilateral banks that that I think we have a lot in common in this collective challenge.
Great, thank you, Tony. And I think some really good points added in there, particularly that point about, how do you also say things that are aligned today but not aligned tomorrow? That raises that whole challenge of that forward-looking data that we might have a little bit, but not necessarily enough to know where folks are going to be a few years from now. And depending, of course, on your time horizons of how you manage your portfolio, that can have a big influence. But I think drawing in this piece about what is needed from the regulatory side as well, and of course, here citing what some of the disclosure requirements or guidance that we hope to be moving forward with, that would help make some of this needed data a bit more available. So now that we've kind of had a first set of reactions from all 4 of our 5 panelists, and again, we'll see if hopefully the EIB will be able to join. What I wanted to kind of do is now just go back to each of you, and I have another question for you, but also an opportunity for you to react to what you've heard from others and build off any of the points that you've heard. Is, of course, I don't want this to be too rigid in terms of how we run the panel, but Camille, I did want to come back to you, again, talking a little bit about the work that your AFD is doing, particularly around intermediated finance. And when you're working with some of your partner financial institutions, how, as one actor, perhaps among many, can the AFD kind of help push this agenda forward of alignment with your clients and counterparties? And what do you see with some of those, what we might need to reach, again, this idea of a critical mass within the financial sector to really see change in terms of practice?
Okay, thank you, Jan. We really think that we won't going to make it just IFD on its own. So we think that it is fundamental to make joint progress on these issues, looking at who we finance rather than solely focusing on what we finance. Because if we do that alone, then there is a risk of having a crowding out effect, and we really need to encourage the whole redirection of financial flows. So we hope by working together with other financial players, and especially with development banks and with DFIs, that we will be able to make progress on all these issues and to adopt a harmonized approach in the field. If we compare, for example, with ESG risks, discussion and environmental and social risk management system with our partners, we're just beginning a few years ago. And since then, all donors and development banks have started to pay attention to this topic, which has really enabled all partners to make progress on this subject. So we really hope that working together on alignment of clients will help to upgrade the disclosure and to take action to reduce non-resilient and emissive assets. We are, of course, also looking forward to learning from other financial actors, especially from the private sector, asset owners, asset managers, insurers, commercial banks, because they have a crucial role to play in setting up standards. And as Amalie said, we are really in the early days, but some of us, some of you have started working on this topic. So we really want to exchange, to identify good practices, to identify challenges, both on qualitative and quantitative assessments, and move forward together. You mentioned TCFD, we mentioned framework for Paris Agreement alignment, climate risk assessment. So really looking forward to work on those subjects together. And we think that it will help giving a signal to the rest of the financial community on the importance of the issue of the counterparty alignment. So really want to thank you for having setting up this working group and this space of discussion.
Great.
Back to you, Jan.
Thank you so much, Kemi. And I think that point of again, working together is something key, and what each of us can kind of bring. And Simon, I know in the exchanges we had in running up to today, you'd mentioned a little bit some of your ideas about, what can potentially the public side, what would kind of be the commercial private sector's ask to the public side about how we can move forward together, and what type of support would you would see as helpful moving forward. I don't know if that's something you want to elaborate on, or if responding to everyone's comments. No problem.
Thanks, Ian. And if it's not too cheeky, I'm also going to pick up one of the questions from James Vaccaro in the chat, because I think there's some great questions there. Thank you, James. So one of the things I find interesting is James's question is, should alignment be considered via financial intermediary counterparties? And where, just to pick up some of the comments to date on things like TCFD, where I think that's really interesting, is that becomes a lot easier if everyone in the finance sector is disclosing their alignment using standardized metrics, because then the moment I think we've still got a bit of a soup of acronyms and methodologies, and you've got to do quite a lot of work to standardize across that. And I'm sure when we're thinking about it internally for our financial institution counterparties as well as just corporate counterparties, but I do think that's the way to go. Help to contribute to the development of those solutions, but then be making sure we are using them. And in particular, I think, and I'm working my way around it into your comment, because I think where that's really interesting for Standard Chartered, for those who don't know us on the call, we're UK domiciled, but we're present as a commercial bank across Asia and Africa, and the Middle East. Crikey, I've said that enough times, I shouldn't struggle. In about 59 markets across those regions. And so one of the challenges we face, two challenges, let me put it that way, is one is those markets are relatively less aligned to the Paris Agreement goals through their NDCs and via their domestic policy frameworks than, say, Europe, which we've spoken to quite a bit in this call so far. The other, of course, is we've done a lot of work on correspondent banking in this context. We're reliant on a large network of banks. In fact, we have quite a significant credit exposure to a large network of banks across our footprint, and we want to encourage them. And so I think that, Ian, takes me to sort of the three parts to the solution here. Part one is good quality reporting. That means that we can see the current state of those FI counterparties' alignment and their efforts there through that reporting. The second, I think, is that we can engage with them to help support them on that journey. But that's where I think the DFI community comes in, because, of course, we spend a lot of time working with DFIs across our footprint as well, whether it's through deploying capital in the form of blended finance, where I think we've got a lot of track record and capability here, but trying to say, okay, effectively, where's the need for a little bit of marginal concessional capital or a little bit of risk sharing here, where we can partner to have a flywheel effect, but also, just as importantly, where other organizations, on the panel here, where we have joint relationships with financial institutions in markets where, there's a pretty low-grade NDC, or where there's no net zero framework. And so part of this is trying to use platforms like NZBA and GFANS to make that accessible as a global platform. But one of the things we've also been working with through NZBA is the concept of country chapters, so things like Bankers for Net Zero in the UK. But rather than the UK, how do you get an equivalent for Uganda? How do you get an opportunity to localize these? And so that's where I think a little bit of more on what might get badged technical assistance can be really helpful from the DFI community, because it's getting in there, it's trying to take these global frameworks, but make them so that they're not just something for the big banks or for the Western banks, but that they're there and accessible for domestic and regional banks. And that, again, in the same way as we're collaborating on today's panel, we're collaborating to do that by bringing together representatives of the development finance community and the private finance sector to say, we both expect this, here's the demand signal, but we're also working on this ourselves. And so here's some assistance in that process.
Great. No, thank you, Simon. I think you touch on a number of really good points here about how to move forward, and some very clear asks there, which of course would be interesting to hear everybody's, from more the public side, thoughts on as well. I mean, of course, thank you for reminding us as well of the questions in the chat. And I'll say now to everyone, probably to keep things organic, just do keep putting those questions in the chat, and we'll see how to draw them in as we move forward on the panel. I also see Wouter has joined us, and Wouter, we'll get to you perhaps. What I'll do is I'll run through both comments from Amelie and Tony, and then we'll get to you and hear a little bit from what EIB is doing. So Amelie, I think here it'd be really interesting to, of course, hear some of your thoughts on, of course, what Simon has said, what everyone said. But I know one of the things, again, I had a critical mass question for CDC Group, again, working as you are working at times through both direct and indirect forms of equity, and where you're just then one shareholder or one participant in a fund of funds, and how do we really move this agenda forward together?
Yeah, no, thanks, Ian. And yeah, so I mean, I'll come on to that. I just wanted to draw on again the question there in the chat about the IEA. I mean, drawing 2 points together. First of all, I mean, the latest IEA 1.5 assessment is excellent. It's great to have it. It unfortunately does not go down beyond global. It doesn't break down into regional, which some previous IEA models and scenarios have. So given we would only invest in Africa and South Asia, and given, there's a sort of recognition that many countries in those regions will need to continue to increase emissions. I mean, obviously not follow a path that others have followed through heavy use of fossil fuels. But I think that's particularly challenging for us as a DFI, because all these global models tend to be, if they do break it down by region, often it's Africa as a whole. Often the numbers there tend to be very dominated by South Africa. Sometimes you see Africa with South Africa taken out, and that's more useful. But really, really challenging from a sort of data perspective and understanding what that pathway might look like. And that's when we look at the transaction level. I mean, and then we also have to, obviously, we're assessing at the portfolio level as well. But also just wanted to flag, I think the point made in the chat is, yes, I mean, we, through our new fossil fuel policy, we would not invest in any upstream or midstream oil, gas, and coal has been excluded for many years already. And interestingly, we would also not now invest in say a renewable energy project, say a solar plant on a fossil fuel exploration. So for example, on a gas plant, gas exploration, where they may want to bring in solar, we would also not invest in that anymore, because we would see that activity, that economic activity, is not is no longer going to be, it's not going to have a long-term role in the future in economic transition to net zero. So I think in that respect, really important to recognize that there will be some activities that just are just no longer viable. I think on your point, Ian, you're right. I mean, in some cases, I mean, where we do direct equity investments, we do then have, we very much ensure that our the investee company is aligned with our own approach, particularly in terms of ESG standards, which is something we've done for some time. And similarly, we're one of the largest private equity fund managers or investors in Africa, and we often act as an anchor investor. So there we can have a lot of influence, positive influence with the manager, and ensure that the investment strategy increasingly are going to be consistent with Paris alignment. But in many other cases, we are, we wouldn't take a majority stake, and as you say, and as others have said, we do need to see this becoming a sort of a collective agenda, a collective movement, if you like, from across the financial sector, so that we are all, providing both the right signals and also the right kinds of support. And I do think, moving forward, it's going to be very interesting to think how best can we do this most effectively and efficiently, so that we, use comparative areas of comparative advantage, but also comparative, resources, whether that's expertise or different types of finance. I mean, already that's been, I think, as Simon referred to, blended finance, which is, relatively advanced in that respect. How do we move, similarly scale up our collaboration as we think more about the sort of engagement that may or may not, and in many cases won't necessarily involve blended finance, but may require some sort of technical assistance to build the capabilities of the particular financial institution or investee. So I think absolutely agree. Very much seeing that there are opportunities to have very positive impact and influence, but this really has to be scaled up through a collective endeavor.
Great, thank you, Emily. I think that idea of comparative advantage, but also comparative resources and what folks can bring to the table, whether it's finance or expertise, is a really key point. Tony, I'll turn to you before we then get to Wouter. And I think here, I know you mentioned a couple points about what maybe is needed at a regulatory level. I think I'd be interested to hear if you have any more thoughts about how again could the public be doing more, and maybe even from your end, if you also could identify perhaps what the private should be doing more as well in terms of helping build this collaboration and being able to move forward collectively.
Yes, you are right. I mean, well, I already mentioned about regulators, in this case, about data reporting, and well, this is something that fortunately it seems that it's happened. So let's have fingers crossed and let's see. But I think that we have a huge opportunity in front of us in terms of what I honestly celebrate this approach at the client level that is shared now by the multilateral banks, by development banks, because it was my feeling, but that this conversation was a conversation among the commercial banks in front of our regulators to say, we have to take into account the efforts that clients are doing, and we have to make an assessment at the client level. Well, it's fantastic to see that this challenge is also shared by development banks, and so I'm very happy to build on that and see how we can engage and work on that. So and then obviously it's a great work that multilateral banks and development banks is doing. But I say that we have a huge opportunity. I'm quite optimistic that we, at the end of the day, we will have to have this 1 billion investment for emerging countries annually in Glasgow. Or I hope that we will have it. So I think we have a huge opportunity to see how we can mobilize. That's what those 100 billion, and to create greatest impact. So we have to work more closely, even more, with development banks on blended finance, on resharing, and try to well, have this multiplier effect that we can have in emerging countries. Through banks like Standard Chartered, we have very strong presence in Latin America. We have practically 60% of our operations is on emerging markets. So we will ask to work more closely. I will ask also to engage with clients, to set alignment targets at the entity level, and in that work, the more we are there, the better. So because that will help also to provide signals to the national governments in those countries that, as was mentioned as well, they don't have today the NDCs with ambition enough, and the starting point is very different. And so it's very important to provide these signals, and also to advocate for this entity level approach in front of all regulators and supervisors. I think it's important. So I think we have a lot to do, and we have. I think we are going to have a huge opportunity to work more closely and to help, especially in emerging countries, to make this work done.
Great, thank you, Tony. And I think this is a great segue to our probably final speaker for today's panel, which is Wouter from the European Investment Bank. And Wouter, again, thank you on what appears a very busy day for the EIB and yourself to being able to join us and perhaps say a few words on what EIB is doing. I'll probably have to cut things off at 2:25, just as a warning, apologies. So Eric has a few minutes to close our panel, but on what EIB is doing and really how, that you've made this one of the foundational pieces of your new climate roadmap. So I think that's very much clearly marking that counterparty issue is here, and it's here to stay, and looking how to move forward. So Wouter, over to you.
Thank you, Ian.
Oops, Wouter, you might want to try turning off your video. Unfortunately, we appear to maybe have lost you. Well, unfortunately, it appears that it's even more complicated day than expected at EIB or in Luxembourg, wherever folks are based. But I guess, yeah, Wouter, we might have to pass on hearing what the EIB is doing and hopefully be able to hear from you next time. But again, I think in some response to what you flagged, Tony, is that, among obviously the DFIs and the IFIs we have on around the table today. Oh, Wouter, are you there? Please feel free to cut me off if you can't hear me. No, it appears that that's not quite the case. That the EIB has integrated this clearly into their forthcoming or their published climate roadmap, and they're looking forward to build those methodologies. And I'm guessing this will be something they'll be moving forward collectively on. Yes, Wouter, now you're back. Perfect.
Sorry, my internet dropped out. Can you hear me?
Yes, now we can.
Okay, apologies for that. And apologies also for being late in the meeting. Thank you for inviting us. I still have 7 or 8 minutes. Ian, is that correct? Okay, can you hear me?
Yes, we can. Yeah.
Sorry. Now, okay, my name is Wouter Meindertsma, and I'm part of the climate team at the European Investment Bank, and I'm leading the work that we are doing on the Paris alignment of counterparties. Now, and during the next 7 minutes, I'll then briefly go over the 3 questions that you've already discussed, and I hope I don't repeat the other speakers too much. I did hear some familiar points when I caught the tail end of Simon's discussion, and I heard some familiar points from Amalie and from Tony. So apologies for that. I'll try to focus mostly on the EIB perspective then. And the first question was about why is it important to also assess the transaction, but also the counterparty. Maybe you've heard it before, but for us, it really started out as a reputational risk. Amalie was talking about solar energy on a coal mine or on a gas facility. Now, any green project for a counterparty that's expanding coal mining, for example, that just presents a reputational risk unless they are really serious about changing their business. That gets a lot of attention from outside the EIB, but also internally, our board was increasingly asking questions about that. But in addition to that, when we started to think about how we would work on the Paris alignment of counterparties, we saw that there was all these national net zero commitments coming up in the EU, in China, the US is back in the game. So there's a lot of national net zero commitments. And then there is increasing scrutiny on companies. So there is companies out there like the Transition Pathway Initiative that are publicly disclosing whether counterparties are aligned or not. And this type of information is also used by investors. So there's pressure on counterparties. And now you then have also upcoming legislation. You have the Corporate Sustainability Reporting Directive in the EU. So for our counterparts, the ones that we work with now, but also the ones that we want to work with in the future, this is really coming up. And we want to make sure that they are prepared, not only on the longer term and net zero in 2050, but we want to see them do something now in the critical decade. And in addition to that, counterparty alignment, it's part of the MDB Paris Alignment Framework, and it's also part of what we commit to do in our Climate Bank roadmap. So it's something that we need to tackle. Now, where does it make most sense? Now, of course, you want to look first at your counterparties in high emitting sectors, and you want to look at those that are present in sectors and in regions that are most vulnerable to climate change risks. Now, so that's where we start. And the second question is then, how does your institution approach this alignment in both areas, and what are the challenges? Now, I won't talk about projects you can find in our Climate Bank roadmap, but I'll stick to the counterparty element. And we are developing a framework. It will be applicable to roughly 2/3 of our counterparties. So corporates, public sector entities, intermediated financing, and it will look at low carbon and resilience. And we are working on it now, and we are struggling to meet the deadline of being able to present something at COP26 in the fall of this year, but we really want to start implementing as of the beginning of next year. Now, we are developing separate methodologies for direct lending, for intermediated financing, and for treasury operations, because there are different operational constraints, different levels of data available. You are working with different time frames. For treasury operations, you might not be able to engage with the counterparty, but you might be able to do that with your direct lending. So we have these 3 work streams, and it's really an interdepartmental effort at the EIB, and that's maybe one of the first challenges. And you have the technical people working on it, you have the climate team, but you also have the front office, you have the operational colleagues, and you have the legal department, you have the treasury department, you have the people from monitoring and reporting. It's a huge group. They all have different interests. And it's quite a challenge to bring all of those people with you in the process and to keep all faces in the right direction. Other challenges include finding this balance between being very thorough, very science-based, and not leaving behind vulnerable counterparties. I heard it several times. I think Tony and Simon were saying it. Yeah, we want to support counterparties. We don't want to leave them behind. We don't want to punish anybody that's lagging behind a little bit. Yeah, at the same time, we want to remain credible. We want to have a bottom line. If you don't want to transition, if you want to continue with coal mining, with oil production, etc., yeah, at some point, we just know we cannot afford to work with you anymore. So finding this balance is quite tricky. And another balance you need to find is between keeping all of this manageable and lean, but also justifiable. We need to be able to explain it. Cannot be too complicated. We need to be able to explain it to in 10, 15 minutes or so. So if you make it very technical with convergence to certain intensities, then it just becomes harder to explain. I realize I'm going very quickly because I see I have 2 minutes left and I like to stay within the time. What I wanted to mention is also we want to not burden our counterparties unnecessarily. We want to leverage existing legislation, such as the Corporate Sustainability Reporting Directive. And this information will need to be public. So let's use that. Let's prepare our counterparties by engaging with them. And we would like to leverage existing initiatives as much as possible, such as the TCFD, such as the CDP. If counterparties are reporting in that format, then yeah, can we use that in our assessments? And can we leverage, for example, what the Science Based Targets Initiative is doing or what the Transition Pathway Initiative is doing? And one other element, Simon, you mentioned it, outside the EU, it's also more tricky. Inside the EU, you have all this legislation. You have counterparties that are already quite advanced and that can also move quite quickly. And outside the EU, that is a little bit more tricky. Ian, we are at 25. I also had a couple more replies to question 3, but we can also give the floor to Eric if you would like.
Or, I mean, if you want to take another minute, I think we could do it. If there's anything else you did want to add, and
good, I'll do that, Ian.
Okay, great, thanks.
What I then wanted to say, and maybe that has also already been mentioned, but how can we create this critical mass and how can we make this successful? Now, what I wanted to say is it's of course very nice that the EIB is doing this, but we only have a limited impact and we are responsible for a very small share of financing. So it doesn't help if we are the only ones doing it. We need to do that together. It also doesn't help if we work with a counterparty that doesn't want to transition and then they go somewhere else for their financing. And I think the key element there is that we need to share our methodologies. We need to be very transparent on that. I think that was also already mentioned, but we also need to share our outcomes. It would be very awkward if we would say a counterparty is aligned and one of our peers would say they are non-aligned or vice versa. So ideally, all of this would become open, all of this would become public. And what I quite liked is somebody said we need to encourage disclosure. This needs to be public, and that's very correct. We don't just want counterparties to justify their Paris alignment or their emissions or their targets or their strategies to us, but we want them to do this publicly so anybody can see it. They can be held publicly accountable, but others can also use this information to do their own Paris alignment assessments. So we also think that encouraging disclosure is key in that sense.
Great. Thank you so much,
Yeah.
Wouter. I think that that's a really good note to end this panel on, of that idea of, transparency and disclosure, and making sure, that again, a key piece of keeping everyone moving in the same direction is allowing everyone to understand really what is being done behind the curtains. And thank you also for kind of pulling back that curtain of the work on progress at the EIB on this. And I think we'll all be interested to learn more. And of course, everyone should hopefully feel free to contact each other about this, as this is kind of, work as it's happening. I'd like now to just ask everyone to give a virtual round of applause to our panelists. And again, thank you so much for joining us today. And, I think being very frank about when this is needed, what's going on, and kind of what we need in order to move forward collectively. And I'd like to hand things over now to Eric Usher from UNEP FI to say a few concluding remarks and perhaps a few words about what we hope to do moving forward. So, Eric.
Thanks very much, Ian, and thanks to everyone on the panel and participants. I mean, obviously, the devil's in the detail. There's so much going on, and I do believe, well, one thing which is obvious is, those who are on today, it's kind of the coalition of the willing and preaching to the converted. We're all working on this notion of alignment in different ways, although we also have to acknowledge that within the mainstream financial markets, it's still rather, I would say, not yet mainstreaming. I think there's a wider, maybe political notion, there's some leadership around it, but the actual actors involved, it's still a fairly small group. We, within the Principles for Responsible Banking, Principle 1, the most important one, is alignment. So it is a framework for the banking sector, which is focused on alignment, which is quite different from the PRI for investment or the PSI for insurance, which really are risk frameworks. Because the PRB was drafted in the post-2015 world, it really focuses on the notion of alignment of businesses with Sustainable Development Goals, Paris Agreement, and the like. As Simon and Tony spoke to, the climate element of that. Well, first of all, it's interesting because of the PRB signatories who it's a disclosure framework, doesn't tell them where to focus, where to align, and climate is by far the #1 topic, north and south. Followed by things like financial access, gender, and other important topics. Climate is #1, it won't surprise you. Within the climate area, we've had a series of stepping up, and the Net Zero Banking Alliance, which is the climate focus now, is by far the most ambitious within the banking sector today. Interestingly, I would not say it's a small group of banks. It includes certainly Simon and Tony and their leading institutions. It includes a lot of other big banks. Tony, it's grown. It's actually 49 today who are signed up. It's 20% of global banking assets who are committed to this notion. If you look at the details, I think those in the development bank community, I think you'd be pleased to see that in many ways, it's very similar to what AFD, EIB, and others are discussing and doing within the development finance world. Commercial banks are essentially aiming to do the same. Of course, there's a real lack of data. There's a real lack of methodologies. These are going to be developed. And I think the notion of the discussion today and potentially the way forward, not that we do everything together, but that we make sure that we communicate. So as these things get developed within commercial banking, within development banking, within the investment universe, within insurance underwriting, that we do our best to connect the dots so we come up with common methodologies, these protocols, which are understandable across the industry. And it's much more important at the holistic alignment of institution level than necessarily maybe at transactions, where it's easier to communicate different notions. For instance, the taxonomy, what is green, what is greening, what is transition finance. The starting point certainly is understanding the transactions, but unless we get to the big picture, we're going to be missing major elements of the portfolio, which in the end is, we're greening in one area and we're maintaining a non-green impact in others, which will obviously won't allow us to achieve the overall objectives, the Paris Agreement. So I think this is a good discussion. I think everybody is super busy. There's so many things going on. So I think it's our collective job to try to figure out, are there ways we can connect some processes? I don't believe we need to establish something radically new. I think we just need to figure out how to make sure we're talking in the right way, we're connecting the right people. We have the GFANZ, the Glasgow Financial Alliances for Net Zero, which for us is new as well. It's important because that is really about getting the banks to talk to the insurers, to talk to investors. And I think here what we're talking about now, Ian, is how do we make sure that the public-private discussion is in a similar way. We're working to make sure we're coming up with common methodologies. My last point is the role of the IFI community, development banks. For us, obviously, you play a very important role in addressing certain non-commercially viable issues, whether they're risks or in terms of building out pipelines of investable assets, etc. However, your ability to establish norms is incredibly important. And as we think of safeguards around environmental social risks, really was through the development community that really got a very strong start. And I think eventually it came up to meet what was happening in the commercial financial community in OECD markets. But I think in a similar way here, we need to figure out how can we work together to establish the norms, because in the end of the day, then it's not only the coalitions of the willing, but that's the way the coalitions actually create the norms that actually impact the rest of the financial sector. And we hear often from, I would say, leaders in the banking or the investment universe, is they say, look, we can do these coalitions of the willing so far, but unless the rest of the industry shifts to this mode of engagement, whether voluntarily or through regulatory approaches, we're just sticking our necks out, and eventually we can only go so far. So I think collectively we have the opportunity, and that also extends to the role of governments, to the role of the UN, to figure out how do you bring up the rear. And a lot of that is through the norms that we can create together. So with that, Ian, I hand it back to you, and looking forward to seeing how we can exactly progress the discussion into something concrete, while being efficient to everybody's time, but knowing that we do need to link up efforts in certain specific ways.
Great, thank you so much, Eric. And I think that definitely draws out the essential of what we'd be looking to do together, as again, in a kind of a light touch, informal group, moving forward between now and the COP, to reconvene, depending on availability, potentially in September and October, again, to touch base, talk about it a little bit more in detail, the how question, then perhaps again in a third session, touch on a little bit more that issue of what do we do this information, how do we adjust our investment strategies and our management approaches. But I think as everyone has been very kind to stay a few minutes over, we can end the call for today. But I'm very happy to have had all of our panelists, all of our speakers. So again, a round of virtual applause, but also to those of you in the audience who have taken the time to join us today. And again, we look forward to engaging with you moving forward to really have this conversation among FIs, bringing the public and the commercial together on how we can advance on the alignment, again, of the entire financial chain. So thanks so much, everyone, and we look forward to speaking with you in the near future. And of course, on what is today a beautiful sunshiny day up in Glasgow, I hope to see many of you in November up here, and that we'll have a little bit of sun. So speak soon and have a good rest of your day.
Thanks, Ian. Thanks, everyone.
Thank you. Bye-bye. Have a nice day.
Thanks. Bye-bye.